Investors miss out on so many advantages in bond investing because they don't understand the investment. By the end of this video, you'll have the 3 keys to investing in bonds to know exactly how they fit in your portfolio. You'll be able to protect your money while still getting a solid return and that regular cash flow. We're talking investing in fixed income today on Let's Talk Money. Joseph Hogue with the Let's Talk Money YouTube channel, where we're creating the financial future you deserve. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, bonds are way underrated by investors. The Federal Reserve found that less than 2% of investors hold any bonds in their portfolio at all. That's despite the fact that most financial advisors recommend holding at least 15 to 50% of your assets in fixed income. Now, that all flies in the face of 2 stock market crashes in the last 20 years alone that really wiped out half the value in stocks. Bonds provide a rock-solid safety and return. In fact, over the 10 years through 2016, stocks and bonds offered about the same level of return, but bonds did it with fewer sleepless nights. Now, I love investing in stocks just as much as the next person, and I'm not saying you should ditch equities altogether, but bonds are going to be that secret asset you add to your portfolio that helps reach your financial goals. I'm going to walk you through the 3 steps to investing in bonds to protect your money while still producing those excellent returns. I'll also show you how to find bonds in which to invest on any online site. I'm then going to wrap it up by sharing my favorite bond investing strategy, something that will make all this super easy, so make sure you stick around to the end of the video. This is going to be a brief highlights video of what's in my book, Step-by-Step Bond Investing. The book is a complete guide into bonds and how they fit into your investing strategy. I'll leave a link to the book in the description below, and I'm going to be discounting the price for YouTube subscribers that click over and check it out. But let's get into those 3 steps to investing in bonds and how you can use these cash flow assets to do some amazing things for your portfolio. First is to simply understand how bonds work. These are debt issued by a company or a government. Investors get a fixed payment of interest, usually twice a year, and then get paid back the value of the bond at the end of the loan. So bonds are really an interest-only loan. Because of how bonds work, there are some important differences with stocks or other investments. Bonds are a contract, so companies have to pay that debt back. If anything happens, then bond investors get paid back before stock investors. So bonds are generally much safer than stocks. Even in so-called junk bonds, which are just companies with a little less solid financials, the number of bonds that don't get paid back is just 3 out of maybe 100 on average. Since all payments on bonds are fixed, that interest and that final payment, the bond's price increases or decreases depending on interest rates in the market. The bond's price has to adjust or people wouldn't be able to sell their bonds after buying them. For example, say you buy a bond for $1,000 and it pays a 5% interest payment or $50 a year. That interest payment doesn't change and the bond is going to pay you that $1,000 back at the end of the loan. Now let's say you bought that bond when the interest rate on US government bonds or treasury bonds was paying 3%. But what happens if the government raises interest rates? Now that treasury bond pays 4% and the rate on those new bonds goes up. Your 5% bond doesn't look so good anymore because investors can get higher rates on new bonds. Well, since those payments don't change on your bond investment, you would have to drop the price if you want to persuade someone to buy it from you. Now, conversely, if rates were to go down, then your 5% bond might be looking even better. Other investors are going to be willing to pay you more money for the right to collect those payments. This can all seem really confusing, but you really don't have to worry about it. Everyone loves to freak out about interest rates and falling bond prices, but if you hold your bond investments to the end of the loan, you'll always get those same payments. You don't have to worry about whether the bond's price went up or down while you held it. So you've got the bond basics down, and now you need to decide which types of bonds you want to buy. We'll be talking about 3 types of bonds, though there are a few more that you'll want to check out in that book. Treasury bonds are loans to the federal government and you pay no state taxes on the interest. The interest rate you get is the lowest among these 3 types of bonds, but there's virtually no chance the US government will not pay on those bonds. Corporate bonds offer the highest return, but you have a little more risk depending on the company. Just like the credit bureaus that rate your credit history and then calculate a credit score, there are rating agencies that tell investors how risky a company is on its loans. These ratings range from C to AAA, with the A's being the safest. Again, looking at these ratings can be a little misleading because you see words like junk bonds and poor quality, but the fact is that even these lower rated bonds are still much safer than stocks. Bonds rated BB by the S&P default at a rate of less than 1 out of 100. Once you get into these C-rated bonds, defaults start creeping up, but the others are extremely safe. Finally, here are municipal bonds, which are loans to states, cities, and local agencies. Now, you've probably been spooked by stories like Puerto Rico and Michigan defaulting on their bonds, but this is just more hype than anything else. Listen, the 24-hour news networks need something to call news. They'll make anything as sensational and shocking as they can if it means they can sell more of that commercial advertising space. The fact is that muni bonds can be a great investment for the right investors. You see, municipal bonds are free from federal income tax, and if you buy those bonds issued in your state, you probably won't have to pay state taxes on the interest income either. That means for investors in those higher tax brackets, it usually makes more sense to invest in municipal bonds rather than corporate bonds and pay those federal income taxes. It's going to depend on your tax bracket, but it's usually around 24% where municipal bonds start making more sense than corporates. So anyone paying that federal income tax of 20% or higher, start thinking about investing more in munis. Each of these three bond types has its advantages. Treasuries are super safe, while corporates are generally the highest return. Munis give the rich a special gift because the rich need all the help they can get, right? Now, before we get into that last step to investing in bonds, I want to ask a question for future videos. What do you think is the best asset class for investing in between bonds, stocks, or real estate, and why? Which is the investment you're counting on to reach your financial goals? So scroll down and leave that in the comment section below so we can get an idea for future videos and the best investments. Our last key to bond investing before I walk you through an example is going to be deciding on a time horizon. That's the length of the loan you want to invest in. Just like any loan, bonds are issued for different time periods, but most of what you'll be looking at will be from 5 to 30 years. Investors locking up their money for longer periods want a higher return, so those longer term bonds usually offer higher rates. One of the great things about bonds, and this is almost always overlooked by investors, is the ability to match your investments perfectly with your financial needs. For example, if you need to pay for college tuition costs in 15 years, your savings for this isn't something you want to totally leave in stocks. So you can put that money in bonds with 15 years left on the loan. You'll collect interest during that time and can reinvest it, and then you get that lump sum payment at the end. Now, a popular bond investing strategy, especially for people living off their investments, is called bond laddering. This is where you match up your near-term expenses with very short-term bonds, ones maturing in a year or two, so you have that consistent cash flow. But then you use the rest of your investment to buy longer-term bonds that pay higher rates. The reason it's called laddering is because you invest in bonds that mature in different years. You invest in enough bonds for each year over the next 5 or 10 to cover expenses in that year. If you don't spend all the interest or the money from the bonds each year, you buy another year's worth of bonds with a later date. So let's look at how to put all this to work. I'm going to show you how to find individual bonds in which to invest, and then I'll get to that favorite bond investing strategy that's going to make it all super easy. I'm going to be using my E-Trade account, but really any online investing site is going to be similar. You're first going to look for the bonds section, or maybe it's called Bond Screener on your online investing site. You'll find a comparison of rates on different types of bonds and different maturities. So here we see that we can get a 2.94% return on US government treasury bonds for 10 years, or we can get 3.9% if we invest in A-rated corporate bonds. If we want to invest longer, then we can get that 3.1% return on 30-year treasury bonds, or 4.2% on the same maturity A-rated corporate bonds. Remember, when you're looking at those municipal bond rates, you don't pay taxes on those, so maybe it's a better deal than the corporate bonds. Usually if your tax rate is around 24% or higher, then it starts making sense to invest in muni bonds instead of corporates. You'll also see here that we can search for individual bonds, so let's try this out. Let's search for corporate bonds that have a maturity of at least 20 years that are A-rated or higher and pay 4.5% or more a year. We have 190 bonds to choose from here with some very tempting yields. Here we have an A-rated bond issued by the South Carolina Electric and Gas that pays a 5.1% yield every year through 2038. Now, before I go to buy a bond, I'd look at the company and do some fundamental analysis. I'd look at things like how much balance sheet debt does it owe and how much interest payments are each year. You want to make sure that EBITDA, now that's basically operating earnings added back with depreciation, is at least 4 or 5 times the interest payments. You also want to look for consistent growth in sales and no runaway expenses that might put those earnings at risk. So if the company looks fundamentally sound, like it won't have trouble meeting those debt payments, you go ahead and buy the bond. Since bonds usually have a face value of $1,000, that's the minimum you can invest for each note. Now, just like picking individual stocks, I like to invest in individual bonds, but I also have a favorite way to invest that makes it all so much easier. For the amount of my portfolio I want to invest in bonds, I usually split it with 1/3 for individual bonds and 2/3 in bond funds. A bond fund is just a group of bonds managed by a professional investor. You pay an annual expense fee, but it's usually so low that it's almost negligible. You pay just one commission to get hundreds or even thousands of bonds in your portfolio, and that instant diversification makes it so a default on one bond doesn't wreck your investments. Now, don't worry, you didn't just waste your time learning all those keys to bond investing. It's still a good idea to know the basics of bonds, and you can still invest some of your money in those individual bonds. I just like the simplicity of bond funds better. So I'm going to highlight 2 of my favorite bond funds that you might consider. First here is the iShares Core US Aggregate Bond ETF, ticker AGG. This is probably one of the safest and most diverse bond funds, with about 2/3 of its holding in government or government agency debt, but it still has some corporate bonds to increase that interest rate you receive. Now, you see that the fund has taken a hit since late 2017 because of those rising interest rates, but that just means the yield has gone up. You're getting an interest rate of almost 2.9% on a super safe collection of bonds here. The next bond fund I like is the iShares High Yield Corporate Bond ETF, or ticker HYG. This is a group of almost 1,000 of those bonds from companies with less than perfect credit, but guess what? It's still a safe investment. With the investment spread across 1,000 companies, even with the 2008 crash, the fund has returned more than 6% annually over the last decade. There are hundreds of bond funds, and you can get into things like international debt, emerging markets, and some other interesting choices, but these 2 funds are what I use for most of my bond investments. If you want to see those other bond funds and get more detail into bond investing and how it fits with your investing strategy, check out that book, Step-by-Step Bond Investing. In it, I take you through everything you need to know in a way that's easy to understand and gives you the tools to protect your money while still getting that return you need. So look for that link in the video description below. If you have any questions about bond investing or even investing in general, be sure to scroll down and leave it in the comments. I always read all the comments to the videos, good, bad, and the ugly, and I love the interaction with you in the community. Don't forget to answer our community question, what's the best investment, stocks, bonds, or real estate? There in the comments below. Join us in the Let's Talk Money community by clicking that subscribe button below. We're here Mondays and Wednesdays with the best videos on beating debt, making more money, and just making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and we'll answer it in another video.